Well, all right. How's everybody this evening? And welcome to the Middle Class Investor. This is Seth Martin, and it's been about 3 weeks since I posted my last video, which was a warning, and this is also a warning about the stock market. The market's down about another 4% since the last time I posted, which is not very much really. But I wanted to post another video because I think we're getting very, very close to a critical juncture in the market. And I think it's important that I'm at least on record warning people. Now, I realize I don't have much of an audience, but maybe somebody will hear this and send it to their mother or send it to someone in their family that they don't want their family member to lose all their savings, and maybe it'll spread around the globe. Who knows? But mostly I'm doing this for people that I know, and I, of course, send it to them. But anybody's welcome to share it to whoever you want to share it with. So what we're looking at is a chart of the S&P 500. And this is a rather long chart. In fact, this chart goes all the way back to the 1932 low after the 1929 crash. Okay, so here's the crash, and then here's the 1932 low, and this is the trend that started all the way back here. Now, why am I putting this big long trend up here? What difference does it make, Seth, that this trend started way back here? Well, because once you have a trend, any trend, it could be a small trend, like one of these in here. Like this is a pretty small trend, but you see you get a pullback. See, you get a trend here, and you get a pullback. Trend here, you get a pullback. Trend here, you get a pullback. And a really long trend just means that the pullback is going to be bigger. So pullbacks happen, right? No doubt about it. This is the 1968 bear market, all through here, and this was a complex pullback that went up, down, and so sometimes they're more complex, like they are here, and sometimes they're very simple, like this pullback here, ran up and pulled back, ran up, pulled back. But the thing to focus on here is just the length of the trend. Almost nobody was investing that's alive today back here. I mean, about the best you can hope for is somebody that maybe was investing in this area in the late 50s. And so nobody has ever really experienced a pullback from a trend this large. Okay, so I just want to try to put that in perspective. And I think another way to do that would be to show you a chart. This is a chart from Elliott Wave Financial. They're a service that charts the market, among other things. They're very, very smart market technicians, and their model is based on something called social mood. We're not going to get into it right here, but there's certain rules to using this model. Some of them we're going to touch on as I kind of lay out the philosophy or the weight of evidence around this warning that I'm giving you. So this chart actually goes all the way back to 1720. In fact, this is the run-up right through here to the South Sea bubble. And the South Sea bubble, South Sea was a shipping company, I think out of Great Britain. And there was a big investment bubble around that, and you had this huge run-up and then a crash. And then the bear market lasted, for roughly 60 years. I mean, from right here, from 1720 to 1780-ish. But I'm not even going all the way back to this. Okay, notice the labeling. So this is a 1, a circle. This is a 2, circle. And this is a 3 circle. So we're finishing a 3 circle. But notice really where I want to go back to is just right here. This is the 1932 low in the market. This is the crash. And this is the trend that started in 1932. Now, there's a couple things that are interesting about this trend. One, it started at the lower trend line. So all this pricing that you see here is contained within the trend line, except for this little overthrow section. So I think this is significant that this trend started at the other side of the trend line and spent, a good chunk of the 20th century and some of the 21st century running up to overthrow the top of the trend line. But ask yourself, if this is the trend right through here, what kind of pullback would be reasonable? And of course, the L8 Wave guys have put in, this is just one scenario. They actually had like 3 or 4. But this could be a scenario. I mean, the market could come here, just do like that, and then start to go back up. Now, it is true that the market over time goes up. But it doesn't do you a lot of good to say that the market over time goes up if you started investing right here and all it did for the next 80 years is go down or sideways. So it is important to know where you are in the trend. You can't just say that the market always goes up. That is true, but it's not factual. I mean, it's factual, but it's not true. One of those. In other words, it's not the whole truth. The truth is the market does always go up because human ingenuity and our standard of living generally goes up over time because of technology, the number of people in our population doing various jobs to create more products and services to make all of our lives better. And this raises our standard of living. So generally speaking, the stock market is all the little fluctuations and everything together show us our standard of living. And over time, our standard of living goes up. But as you can see, we're likely to go through some sort of dark ages. Now, that doesn't mean it'll just be a depression the whole time. It just means that the market's going to go down. It's going to come back up. So if you ride it all the way down, maybe this takes 30 years, 40 years to come back up, which I'm guessing some of you don't have that much time. So the reason I'm putting out this warning is because you might consider, it's your money, so you get to decide, right? But you might consider just stepping out of the way for this what looks like a collapse, but this is just a pullback in a very, very long uptrend. And you might consider stepping aside, going to cash or money market or something like that, and let this train roll on down the track. Now, again, it's your money. You get to decide. I'm not telling you what to do. I'm not making any recommendations to buy or sell securities or whatever it is those people say in these types of videos. I'm simply talking about the nature of this trend and what is likely and probabilistically going to happen as a result of the completion of this trend. Okay? That's really all I'm saying here. All right, let's close that back out. And then what I want to do is I'm going to come back to this chart and I'm going to zoom in a little bit. Right now, each one of these bars on the screen is a month. That's why you can get so much price action on one page like this. But what I'm going to do is I'm going to change this to I'm going to change it to a weekly. So we're going to go to a 20-year. Now this is just since the 2009 low. So this is the trend from 2009, and this is also 5 waves. And I'm going to show. Well, actually, I don't know if I can show you Let me do this. Let me zoom back out. Sorry, let me zoom all the way back out. And then let me start back here and then zoom in from here, because the way this zoom tool works is it almost zooms in too closely. So what you're looking at right now, whoops, is you're looking at the 2009, whoops, sorry about that. The 2009 low down here. Let me get that off the screen. Sorry, this thing is challenging me a little bit, and that happens sometimes. Now I'm too far. Let's go to about right there and then do that. Okay, so what you can see here is you can see the market. This is the 2009 low. This move down right here is the financial crisis, okay? Which was, not insignificant. And then, of course, once the market stopped going down, then it starts to go back up, right? And so I'm just going to draw the major trend here, because you can see there's a 1, 2 here and then another hump. But I'm just going to draw the major trend here. It's 1 and then 2. And then this is all 3 right here, all through here. This is 4. I'm sorry, I did that wrong. Let me back up. This is all 3 right here, all the way to there is 3. Okay, and this is 4. This is the COVID low. And this last run up is 5. So not only can you count 5 waves from the 1932 low, the very last wave, the 5th wave, counts as 5 waves. And this is very typical of the market. The market is what's known as a fractal. So as you zoom in, you can start very far out, and then as you zoom in at smaller and smaller degrees, the market looks the same. In fact, we could go through that exercise. I'm not going to do it, but I could show you a monthly, then show you a weekly and a daily, and actually not tell you what the actual time frame is, and the market would look the same at all these different degrees of trend. And that's the nature of the market. It fluctuates at all degrees of trend the same way. So when I say that, after 5 waves, there's a pullback, that actually happens even in a situation like this. There's 5 waves in here. I don't know if I can count them all. It looks like maybe there's this may not be accurate, but let me just kind of take a stab at it. There's 1, 2, 1, 2. I think 3 goes to here, 4, and then 5. But then look what you have, a pullback, right? And this pullback was pretty significant. So the pullback can be significant like this, or, actually, if I was looking at it at the time, and I don't recall if I was, I probably was looking right here for the pullback to end, because normally on the wave 4 low is what you look for a pullback. And so that's why this yellow box is on the screen, is I've got the wave 4 low marked here as a pullback for this part of the trend. I mean, again, you go back to the 1932 low, and we're targeting something much deeper, even deeper than this. But the thing I want to impart to you right now is there's going to be a pullback. And the pullback could look something like this, where it pulls back to here and then rallies, maybe back up pretty high, maybe up to there, and then pulls back in a 3-wave move. This is typical of a pullback. Okay. We can see that, by the way. I may have to go to like a different time frame, But I wanted to show you that even these waves, even in here, they break up. Like right here, this is a wave 4. Let me just show you. This is a wave 4 right here. So from here to here is a wave 1, wave 2, wave 3, wave 4, wave 5. So all these little trends break down into other little trends. And so you can see here there was a trend and there was a pullback. There was a trend and there was a pullback. And sometimes it's shallow, right? If it's in the middle of the trend, it can be quite shallow. But when it's toward the end of the trend, it looks like this is toward the end of the trend. This is the end of this trend right here. So look how sharp that pullback was. In fact, let's zoom in on that. See how sharp that pullback was? So let me switch to a daily time frame. Well, let me go to a weekly. I'm going to go to a weekly. I guess I was already on a weekly. So what I want to show you now is why does Seth Martin think this is the top? Why is this the top? Well, first of all, let me just say that this right here is a wave 4. This, what you've got here is you've got this A, B, C kind of move here. And so that means this is likely to be wave 5. Okay. So once we've had 5 waves, we look for a pullback. Now I want to zoom in on this section right here, and I want to count. I've done this before. I did this in the last video, but I just want to do it again so you can get a sense for what we're looking at. So there's a rule in trading that if you have an important high, which this is an important high, okay? The main reason it's important high is it's the all-time high, okay, in the S&P 500. The all-time high is 4,818.62. Now, once you have a high, an important high, and you get an initial move down, okay, in 5 waves. So let's count it. 1, 2, 3. Now you might be wondering why I didn't stop here. And that's because this wave 3 is made up of, there's this wave 4 in the middle of wave 3. That's very typical. So there's wave 3, here's wave 4 up, and wave 5 down. Now, one of the things I want you to notice, this is always kind of interesting too. This is the 50-week moving average, this purple line. And notice once it kind of went through it, then these lines started to become resistance. Like first this line was resistance, this light blue line, which was a 10-week moving average, because I'm on a weekly. See, I got a weekly candle here. So, and then the next move down, the rally up, it rallied up into the 50-week. So first it rallied up into the 10, then it rallied up into the 50. And that's pretty typical. These moving averages tend to be resistance and support and things like that. All right, so the other side of the coin is once you have a move down, or it can be a move up. It doesn't have to be a move down. It just has to be in 5 waves. That tells you the trend is potentially changing. Now, what do we need to see in order for the trend to be confirmed changing? Well, we need to see a counter trend move. So we need to see something in 3 waves. Now, this is an 3 waves here. Yeah, that didn't do right. That's 3 waves here, but this is what we call this is called a double zigzag, and it has an X wave in the middle. And then the final wave is made up of 5 waves. But this whole thing is counter trend. It overlaps a lot. Now this overlaps a lot too, but this is an expanding diagonal, so it doesn't matter that it overlaps. So this is a counter trend move. Counter trend meaning against the trend, meaning this is the direction of the trend, and so this is counter trend. Okay, those are the first 2 or 3 things to realize. Now, something else that's important that I want to point out is in this move up right here, this one right here, it breaks down into 5 waves. And the rule is this price action, this down move, cannot cross into this wave 1 here, which is right about here. This wave 1 is right there, kind of ends right there. So once we get price action below here, you should see this accelerate pretty quickly. And this is why I'm making these videos, because once this starts to accelerate and you start getting bars that look like this, you're really not going to know what to do. The psychology of the market really starts working on you, and you start telling yourself, well, you know, if it rallies, I'll get out, but then it rallies and you don't get out, and it's just a tough psychology kind of environment, the market. And so this is why the warning is coming now, because if you start getting bars here, let me zoom out a little bit further. Let's go to max. Sorry about all this adjusting here. And some dead air for you. All right, so if you start getting bars that look like this in the market, trust me when I tell you, you're not going to know what to do. You're going to tell yourself, and you could even get a really long one in here like that, and then something like this, maybe to there, and then a rally back up. Okay. These are breathtaking kind of moves, and when you get them, you don't really know what to do, and so you just kind of stare like a deer in the headlights. And this is fine. I mean, you can go back to the 2020 lows. This is the pre-COVID lows, okay? Because probably it'll do that, and then it'll come back down like this into this yellow box area. And then we'll get a rally, right? I mean, it's not the end of the world if you held through this, but why not sell somewhere in here, you know? Like sell right here and not take all this. Because then what happens is you get a rally, maybe something that looks like this, back up to here. And then the next move, and you tell yourself, oh, I'm going to sell. And you know what? You don't sell. And the next move's down is even worse, like this. So this is just how the psychology in the market works. This is why I make these videos. I don't have an audience big enough to make any money doing this. This is just me sharing my thoughts about the market. And because it's your money and you're in control of your money and you need to be responsible. I mean, look, people that don't make money in the market are always blaming somebody else. You have to take responsibility for your money or you'll never make any money in the market. And taking responsibility means, if you hold through some big sell-off, then there's nobody to blame but yourself. So, but just suffice it to say, this is probably, the first stop will be here. We'll rally some. The next stop will be down here. We'll rally some, so on and so forth. And that'll continue until it's done. And just keep in mind that at a minimum, we're coming back to the 2009 lows. If we come back to the 2009 lows, we're still solidly in an uptrend. In fact, if we come all the way back here to the, what is this? That's the 1974 bear market low. I was just a young lad of 8 back then. Even if we come back to here and start to turn back up, it's still an uptrend, okay? So just keep that in mind, that these types of pullbacks happen all the time in the market. And there's no reason to think that they're not going to happen now. All right, what else do I need to talk about? I guess that's about it. What you'll probably see too, and I wasn't really prepared to talk about the bond market, but the bond market, as you can see, has been going straight down. And this is not one I track as carefully, but you can start to see, like, it looks like maybe there's, 1, 2, 3, 4, 5. It looks like maybe there's 5 waves here, which means we're going to get a rally. So this makes a lot of sense, because if we get a rally right here in the bond market, probably it's because we're having a big sell-off in the stock market. Because what happens is when stocks start to sell off, and a lot of these mutual fund investors and institutional investors, they have to be invested all the time. They can't just go to cash. So what they'll do is they'll look for places to park their money, and they'll park it in the bond market. And so what ends up happening is, as stocks are going down, as you start getting some sort of move, like we've been talking about, like this is going to cause all these institutional investors to run over into the bond market. And that, you can see here, that's the TLT. Well, it's the TLT if you're trading ETFs. And you can see that if a bunch of people start running out of stocks and into bonds, you can probably see, this rally pretty big through here. Something like that. And then roll back over. And so if stocks and bonds start to go in opposite directions, right now they're kind of going in the same direction, although this is a pretty big move. I mean, this is causing a lot of bank stresses, by the way. This is something I haven't spoken about on this program, but another thing you could consider doing is putting your money in a credit union. And the reason I say that is because these money center banks like Bank of America, Wells Fargo, Chase, these banks probably hold a lot of these bonds. And at some point, this is going to create a lot of problems for them. Maybe not yet. Maybe we're going to rally and they'll be able to sell some of them off. But when this rolls back over, it's going to create a lot of problems for banks, because banks are holding a lot of these treasuries, because what they see it as is risk. Banks make money. Everybody knows that banks make money by loaning money, right? But if they don't loan money, typically what they want to own is they want to own assets. A mortgage-backed security is an asset. Banks don't really hold mortgages per se anymore. They hold securities that are backed by mortgages. And they hold U.S. paper, U.S. Treasury bills and notes. And so the problem with the bond market really selling off as fast as it did, and there's no mistaking, this is a very rapid move for the bond market. I mean, you're basically going, we're back at, we're back at 2006 prices. I mean, that's something, This is all QE. All through here was QE 1, 2, 3, 4. I think this was 4. And so it's significant that we're at 2006 lows already. I mean, let's see how much time this is, just for grins and giggles. Can't see it. Okay, so this was 1,300 days, 54% decline in the bond market. I mean, that's just a huge move. I mean, you can see if you look back here at some of the older price action, you can see that bonds just they kind of meander around. They don't go like this. So this is a real problem, and I suspect when stocks really start to accelerate to the downside, you're probably going to see bonds go back up. So let me just leave you one more time with this picture. And just remember that, let's zoom in here a little bit. We're really only talking about this 5-wave move here. You know, we could get a deeper pullback like to here, right? But all I'm saying is that we're going to pull back to at least here. That's really all I'm saying. And if you don't think that's possible, you don't understand the market. Because that is not only is that possible, but it's highly probable. It's in fact, we'll probably pull back here into basically one move, rally, and then pull back even further in an ABC. So keep your eye on this. This is the 2009 low right here. That's the 2009 low. So we're probably coming back to that. So I'll leave you with that. Thank you for watching my video. Share it with somebody that you care about, that maybe you like to vacation with. Don't share it with people you don't like, people that are greedy and stingy and deserve to lose a lot of money in the stock market. Don't share it with them, but share it with the people that you like, people that you love, people that you care about. And keep, subscribe, hit the subscribe button, and keep an eye out for videos. I don't make them very often. In fact, the one previous to this was 3 weeks ago. So that'll kind of give you an idea how often I make them. But if I see important junctures in the market, things that not only warnings about getting out, but if I see a good area to maybe get in and go long, where you can be long for, let's say, a year or something like that, then I'll probably make videos for that as well. All right, everybody. Thanks for coming in. Appreciate your time. Peace.